I will ask this question from Chris Freed from Philadelphia, and whoever wants to take this on stage. From raw material purchases by Berkshire subsidiaries, are you seeing signs of inflation beginning to increase?
Let me answer that. Greg can give more. We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us, and it's being accepted. I mean, it's not...
Warren Buffett has been thinking about inflation for a long time. We're seeing very substantial inflation, Buffett said at last month's Berkshire Hathaway annual meeting. We're raising prices, people are raising prices to us. And it's being accepted. In April 2021, consumer prices increased by 4.2% over the previous year, the highest increase since September 2008. The spike has alarmed investors, with some speculating that we may be returning to the 1970s, when inflation was in double digits. So, why should investors be concerned about inflation? Inflation, or an increase in prices over time, leads you to lose purchasing power. If inflation rises high enough, this might change what looks to be a good return into a negative one for investors. Owning a bond that pays 5% interest yearly may appear to be a good investment, but if inflation rises to 6%, your actual return will be negative. As the economy recovers from the COVID-19 pandemic, prices are on the increase once more. It's worth revisiting some of Buffett's best suggestions for combating what he once referred to as a gigantic corporate tapeworm. Gold is the answer to inflation, right? Warren Buffett has avoided gold, which is typically regarded to be a good inflation hedge. Gold enthusiasts are particularly concerned about the impact of inflation on paper money, a concern shared by Buffett. If you own 1 ounce of gold for an eternity, you will still own 1 ounce at the end, he said in 2011.
If you buy an ounce of gold today and you hold it 100 years, you can go to it every day and you can coo to it and you can caress it and you can fondle it and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it, all kinds of things. For 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end of the 100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400. But you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time. Now, in any given 1-year period, 5-year period, any asset can outperform another.
Instead, he likes to invest in assets that create dividends, income, and food for their owners, such as stocks, real estate, or farmland. Cryptocurrencies have been referred to as the digital version of gold in recent years, but Buffett is suspicious about them.
When you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. I mean, you look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing. One of the interesting things, for example, is gold. If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe 1/10 or 2/10 of 1%. And then you have to insure it during that time and make sure somebody doesn't steal it from you and everything. But it doesn't produce anything. And productive assets, you can pay too much for a productive asset. But I bought a farm in the 1980s, and every year look at how much it produced the way of soybeans and corn. And at the end of that period, I've still got the farm, and I've gotten some significant income off of it. Apartment house, operating business. But if you and I buy various cryptocurrencies, they're not going to multiply. They're not going to be a bunch of rabbits sitting there in front of us. They're just going to sit there. And I got to hope next time you get more excited after I bought it from you, and then maybe I'll get more excited and buy it from you. And actually, we could sit in the house by ourselves, and we could keep running up the price between the two of us. But at the end of the time, there's one Bitcoin sitting there, and now we got to find somebody else, and they come to an end.
Bitcoin has no unique value at all, he told CNBC in 2019. It doesn't produce anything. You can stare at it all day, and no little Bitcoins come out or anything like that. It's a delusion, basically. Now, what are the best ways to hedge against inflation, according to Warren Buffett? Number 1. Invest in low capital required businesses.
Businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth.
Buffett has long pushed for holding firms that generate significant returns on invested capital. During inflationary periods, businesses with minimal capital requirements that can sustain their profitability should perform better than those that must invest more money at ever-increasing prices, merely to stay afloat. Number 2. Look for businesses that have the ability to raise prices during periods of rising inflation.
And that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and the value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues, and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate investment or a huge investment to support it, will do well.
During periods of high inflation, a business that can raise its pricing has a significant advantage, since it can offset its own rising costs. Buffett famously argued that, in an inflationary society, an unregulated toll bridge would be the best asset to possess, since you would already have built the bridge and could raise prices to balance inflation. Number 3. Make an investment in yourself and strive to be the best at what you do.
The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. And if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So
the top surgeon or lawyer in a city or town benefits from an education paid for in old dollars, but may charge current dollars for their services without having to re-educate. Consider adding a new skill to your tool belt by using internet resources or enrolling in a local institution. Advanced degrees can be costly, but they can also help you expand your knowledge base and make you a valuable employee in the future. Over time, increasing your worth to your employer and its clients will help you command a fair portion of the profits. Number 4. Avoid traditional bonds.
in the picture. And the one thing we know is we think that long-term bonds are a terrible investment.
Bonds are not the place to be these days, Buffett addressed to Berkshire stockholders in a letter in 2020. Bond investors could be severely harmed in an inflationary climate if interest rates remain around record lows. A 10-year bond yielding 2%, according to Buffett, is comparable to paying 50 times earnings for a corporation, with the exception that the bond's earnings cannot expand. Fixed income investors worldwide, whether pension funds, insurance companies or retirees, face a bleak future, he said. Finally, number 5. Limit your wants.
Well, Charlie and I have always been big fans of living within your income, and if you do that, you'll have a whole lot more income later on. And
Charlie Munger, Buffett's business partner and vice chairman of Berkshire Hathaway, has his own ideas about how to deal with periods of excessive inflation. One of the great defenses to being worried about inflation is not having a lot of silly needs in your life, Munger told Berkshire shareholders back in 2004. In other words, if you haven't created a lot of artificial demand to drown in consumer goods, then you have a considerable defense against the vicissitudes of life. Consider using a budgeting tool to help you keep track of your expenditures. This can help you understand how you're currently spending your money and may allow you to spot issue in your spending before they become a habit. The bottom line is, it's still too early to say if the current inflation increase will be permanent or only transitory. If you're worried about rising inflation, follow Buffett's suggestion and invest in productive assets like high-quality enterprises with modest capital requirements, rather than low-yielding bonds that don't boost payments in line with inflation. With this, I hope you guys was able to get valuable lesson to combat inflation. With that, business wisdom, signing out.